When the market is in a perfect uptrend and the price keeps climbing, it respects demand zones and consistently breaks structure to the upside. In simpler terms, it forms higher highs followed by higher lows every time a structure is broken. A fresh demand area naturally forms. This structure break is only considered valid if there's a candle that decisively breaks and closes above that level, while a wick pushing past the high shows buyers briefly took control and drove the price upward. It also reflects an instant pullback into the range. This usually signals a liquidity sweep, triggering stop losses of traders who shorted based on prior rejections. If we then see another break with a strong full body candle, it confirms a genuine breakout. Now, this zone can be marked as the latest higher low as long as the price holds above this zone. The market bias remains bullish and we continue to look for long opportunities. However, if you identify a clear reversal pattern, you might consider taking a short trade aiming for this demand zone, since it continues to serve as a solid support level for price. A shift in character is confirmed when there's a break and close beneath this low. This indicates that buyer strength is weakening and the market could potentially change its structure and begin a downward trend phase. The same principle holds true in a bearish context. When the market is in a clean downtrend and price keeps moving lower, it respects supply zones and consistently breaks structure to the downside. In other terms, it forms lower lows followed by lower highs each time price breaks through a structure level heading down. A new supply zone is naturally established. As long as the price remains under this swing high, the trend stays bearish and our focus is strictly on selling this asset. Here's a case in point. This is the recent price action of the euro-dollar pair on the 1-hour time frame. Notice how the price consistently respects lower highs and keeps breaking structure to the downside, forming an ideal downtrend pattern. You can easily spot structure break swing highs and lows along with possible trade setups by studying the chart. If you're struggling to determine who's in control, it's usually a sign to skip this pair and look elsewhere. With that said, the reality is the market rarely moves in such a clean and obvious manner. In imperfect uptrend trending conditions, the market may dip below higher lows yet still push in the same bullish direction. This often misleads traders into believing the uptrend has ended. These moves are typically intended to capture liquidity or to rebalance price around fair value gap zones. In this video, we're diving into how to navigate imperfect trending markets and determine true market direction without getting caught by false reversal signals. We'll be introducing you to a high-level trading method. Ways to recognize false reversal signals. Most effective method to determine market bias. Criteria for confirming a valid change of character. How to distinguish between major and minor swing levels. Understanding liquidity grabs and fair value gap mitigation. If you're interested in mastering advanced trading concepts, strategic entries, and staying consistent with your trading plan, be sure to drop a like to support the content and subscribe to the channel if you're joining us for the first time. Quick heads up, if you haven't grabbed it yet, we just launched a free ebook called Unlock the Entry Secrets of Market Makers. It's packed with powerful insights to help you understand how and where the big players enter the market, something every serious trader should know. The link is in the description. Go download it now and take your entries to the next level. Welcome back, traders. Let's dive in. Here's an example of what an imperfect trending market can look like at first glance. It might seem erratic and lacking clear direction, but in this video we'll walk you through a method that turns this chaotic chart into a clearly defined trend. The main idea is that in these less than perfect trends, it's essential to concentrate on the broader structure instead of reacting to every small break. Many of these minor pullbacks are short-lived and often serve to hit stop losses or collect liquidity from retail participants. The first concept, we'll cover how to classify major and minor price swings in a trend. When does a swing high or swing low qualify as strong, and when is it regarded as weak? In an uptrend, major swing lows mark critical zones where break of structure moves start. This level reflects the most recent highest price traded following a breakout above the previous high. Thus, the start of this impulsive move defines our major. Lower change of character is confirmed if price breaks below this particular level. Other swing lows are seen as minor, and breaking beneath them doesn't signal a genuine trend reversal. Now, an important point to remember is that we can only mark a level can be identified as a major swing only after a valid break of structure has occurred. For example, this low can't be labeled a major swing low until a valid break of structure happens. It represents the most recent highest price traded, so a break of structure is only confirmed when price moves decisively beyond this point. As mentioned earlier, only after a valid break of structure can a level be marked as a major swing. Therefore, this level is recognized as a major swing low while the rest remain minor. Breaking below a minor swing low also signals a loss of bullish momentum. If you spot a strong setup like a reversal or liquidity sweep pattern from a higher timeframe key level, you might consider entering a short trade targeting the major swing low. This is because once this level is tested, a tug of war between supply and demand usually unfolds, often causing a rejection. However, trading against the primary trend carries risk as it raises the likelihood of being stopped out, essentially swimming against the current. Now let's review the bearish scenario. Understanding how to separate major from minor swings allows you to clearly determine market direction and spot genuine reversals. Once the lowest recent price is broken, the starting point of that impulsive drop is identified as our major high. On the euro-dollar 1-hour chart, we observe 1, 2 and 3 impulsive moves breaking below this low, forming a clear trend. The starting point of this move is marked as our major high. As long as price holds below this point, the market remains in a downtrend. Now let's keep identifying major and minor swings. Once price breaks through and prints a new low, we label the level where that move started as the next major swing. If price only wicks below the recent low, it doesn't count as a valid break of structure and is treated as a minor swing. Moving above a minor swing doesn't confirm a change of character. A valid reversal occurs only when price breaks above the major swing low. We continue mapping major and minor swing lows until a valid change of character takes place, confirming the reversal and switching our outlook to bullish. This covers the first criterion for defining a major swing, the point where a break of structure begins. There are still two more criteria to help us confirm major swings and validate market direction. Number 2, recognizing fair value gap zones. A bullish fair value gap signals a buy-side imbalance where the buying momentum clearly overpowers selling pressure, often due to institutional involvement. The demand zone responsible for this gap is seen as stronger and typically causes a reaction when price returns to it. From the imbalance point of view, demand zones featuring fair value gaps are treated as major swings, whereas zones lacking such gaps are viewed as minor swings. A break below a major swing that formed with an imbalance indicates a notable shift in momentum and hints at a possible trend reversal. The same principle holds true for bearish setups. In this example, we observe 3 price points. The first does not display a break of structure or any imbalance, so it's classified as a minor swing. Breaking below it doesn't suggest a momentum shift or reversal. The second marks the origin of a breakout but lacks any imbalance, making it a major swing with a single star. The third point initiates a breakout and forms an imbalance, which qualifies it as a major swing with 2 stars. I hope this is clear. So far we've covered 2 key factors that determine whether a swing point is significant and major. Before we move on to the third and final factor, let's explore a potential trade setup. In this case, we identify a major swing low that initiated the break of structure alongside another swing that generated an imbalance. This zone is treated as a strong swing point despite lacking a breakout. When price revisits this level, we anticipate a rejection, but if it breaks below, it signals growing bearish momentum. This setup is common when price interacts with a key level from a higher time frame. At this point, we can consider short positions within the inverse fair value gap area targeting the major swing low, since it still serves as a significant support zone for the price. Now let's explore the third and final criterion that helps us spotting major swing points: magnitude of price advance. Observe this scenario. The most recent move resulted in an imbalance and breached the structure level to the downside. By definition, this is considered a major swing low, but does breaking above this high truly indicate a valid change of character? If your answer is no, can you identify what's off in this case? The problem with this move lies in its limited price displacement. When comparing, the previous impulsive move covered over 60 pips, whereas the latest one only managed around 20. As a result, this high cannot be classified as a major swing, and a break above it does not signify a legitimate change of character. So here's a key takeaway: to recognize a level as a major swing, the move it makes must cover at least half the distance of the prior impulsive leg. This serves as our third and final criterion for identifying major swing points. Now, let's examine a few examples. In the first case, none of the 3 key criteria are met, so it's classified as a minor swing point. In the second example, there's a valid break of structure and a strong price move, but no imbalance, making it a major swing point with 2 out of 3 criteria met. In the third scenario, we see an imbalance and a significant distance covered, but no valid break of structure. So, it's also considered a major swing point, again earning 2 stars. Finally, the last example meets all 3 criteria. It shows imbalance, breaks structure, and has a strong push in price. This qualifies as a major swing point with 3 stars. A break below this low signals a valid change of character, indicating a confirmed shift in market direction and momentum. Additionally, there are two exceptional scenarios that can invalidate a change of character: liquidity sweeps and fair value gap, FVG, mitigations. While this may seem complex at first, it will become clear as we break down each concept step by step. In this example, we observe a major swing low that served as the origin of a breakout. Breaking below this level typically indicates a valid change of character. However, if you look to the left, you'll notice this level aligns with a key liquidity zone. Many traders have previously entered long positions around this area, placing their stop-loss orders just beneath it, creating a liquidity pool. To trigger these stops, smart money may drive the price slightly lower to sweep liquidity, only to resume the bullish trend afterward. Key insight: when a major swing point aligns with a significant liquidity zone, a break below, or above, that level is often just a liquidity grab, not a confirmation of a trend reversal. Price may simply be hunting stop orders before continuing in its original direction. Keep this in mind: in such scenarios, the break cannot be considered a valid change of character if price quickly returns back into the range. This typically signals a bullish continuation, offering an excellent opportunity to go long. Smart money has triggered sell-side liquidity, and the next target becomes the buy-side liquidity. As smart money traders, our goal is to enter after stop losses have been hunted, not before. This concept is known as a liquidity sweep. But that's just one piece of the puzzle. There's another scenario that can invalidate a change of character: the mitigation of a fair value gap, FVG. We all know that a fair value gap, FVG, refers to the price gap created between the wicks of 3 consecutive candles on a chart, regardless of their color. Specifically, when the upper wick of the first candle does not overlap with the lower wick of the third candle, this area is marked as the fair value gap. For smart money traders, identifying these FVGs should be one of the first steps when analyzing a chart. But why is it so important to pinpoint these fair value gap areas? Beyond the reasons we've already discussed, the market often returns to these fair value gap areas to fill them because they represent inefficiencies in price movement. These inefficiencies, also called imbalances, highlight zones where liquidity is lacking. Large institutional players typically act to fill these gaps in order to rebalance orders and promote smoother, more efficient price action. This process helps the market maintain stability and allows the trend to continue more smoothly. As a result, fair value gaps often act like magnets, drawing the price back before it resumes its original direction. Fair value gaps are best identified on intraday timeframes, which means charts with timeframes less than 1 day, such as 4-hour, 1-hour, or even shorter periods. While fair value gaps can be applied to any asset, they tend to be most effective in markets with high trading volume, including forex pairs, stocks, cryptocurrencies, and futures. With that context, let me now show you how the mitigation, or filling, of a fair value gap can invalidate a change of character. Referring back to the previous example, observe the left-hand side where an unmitigated fair value gap lies directly below the major swing. In such cases, the price typically retraces to this fair value gap zone to restore balance, which does not signify a genuine reversal. It's crucial to analyze the left side of the market structure to distinguish whether the price movement is simply filling a fair value gap or signaling a genuine shift in market sentiment. This approach helps you avoid false signals and keeps you trading in sync with the bigger market flow. Before we wrap up, remember, while spotting fair value gaps and shifts in market structure are powerful tools, mastering smart money concepts takes time and consistent effort. No single strategy is foolproof, but by sharpening your skills and combining these insights with solid risk management, you can seriously boost your edge. Keep grinding, study those charts, stay disciplined, and let smart money guide your moves. If this video added value, smash that like button to show support. And if you're new here, hit subscribe, because we drop advanced trading concepts regularly. Catch you in the next episode.